Hello everybody, and this time we are talking about bank credit. Bank credit is the amount of credit available to a business or individual from a banking institution in the form of loans. Bank credit, therefore, is the total amount of money a person or business can borrow from a bank or other financial institution. A borrower's bank credit depends on their ability to repay any loans and the total amount of credit available to lend by the banking institution. Types of bank credit include car loans, personal loans, and mortgage. And then we move to characteristics of bank credit. The first, borrower, a person who borrows money. And then the second, lender, the person who lends money is usually the bank. And then third, rate of interest. The interest rate can be a fixed or floating rate of interest. The floating interest rate is based on benchmark rates like Jakarta Interbank Offer Rate or London Interbank Offer Rate. And then fourth, terms of repayment. These are mentioned in the loan covenant and strictly adhere to avoid the prepayment penalty. And then fifth, mode of loan, normally given in cash, but sometimes will be given in the form of raw material or fixed assets. And then we move to primary functions of bank credits. Bank credit enables individuals and businesses to access funds beyond their immediate cash reserves, supporting consumer spending, business growth, and economic activity. Banks assess borrowers' financial health to manage risk and ensure responsible lending. A primary function of bank credit is providing liquidity, allowing borrowers to make purchases or investments without waiting to accumulate savings. This is especially useful for businesses managing operational costs, purchasing inventory, or funding new projects. By offering credit, banks keep money circulating, preventing slowdowns caused by cash shortage. And then risk management is central to lending. Banks assess credit worthiness using financial statements, credit scores, and income verification. They also diversify loan portfolios to limit exposure to any single borrower or industry. Regulatory frameworks such as Basel III capital requirements ensure banks maintain sufficient resources to cover potential defaults, protecting both the institutions and the financial system. And then how to apply for credit. Bank credit refers to loans extended by a bank to individuals or businesses. As a borrower, you can apply for different types of bank credit, such as personal loans, home loans, auto loans, credit cards, and business loans. To increase your chance of getting approved for bank credit, you have to first, you should have a good credit history. Banks will check your credit report and score to assess your credit risk. A higher score and a clean repayment history can increase your eligibility and approval terms. And then second, have a stable income. You must show proof of a steady income for personal loans and credit cards to repay the loan. For business loans, your business financials and revenue streams are evaluated. And then third, provide collateral. You may need to provide an asset as collateral for secured loans like home and auto loans. The collateral reduces the bank's risk, allowing you to borrow more money or get approved more easily. And then fourth, submit the required documents. Common documents include proof of identifications, income statements, tax returns, bank statements, and collateral documents. Ensure all documents are authentic and up to date. And then fifth, meet the bank's eligibility criteria. Different banks have lending criteria regarding income, age, employment, etc. Check the criteria before applying to see if you meet them. And then we move to types of bank credit. Bank credit comes in two different forms, secured and unsecured. Secured credit or debt is backed by a form of collateral, either in the form of cash or another tangible asset. In the case of a home loan, the property itself acts as collateral. Banks may also require certain borrowers to deposit a cash security in order to get a secured credit card. Secured credit reduces the amount of risk a bank takes in case the borrower defaults on the loan. Banks can seize the collateral, sell it, and use the proceeds to pay off part or all of the loan. Because it is secured with collateral, this kind of credit tends to have a lower interest rate and more reasonable terms and conditions. Unsecured credit, on the other hand, is not backed by collateral, so these kinds of credit vehicles are riskier than secured debt because the chance of default is higher. As such, banks generally charge higher interest rates to lenders for unsecured credit. And then we move to advantages of bank credit. The first advantage, access to funds. People, businesses, and governments can get money from banks that they might not have on hand right away. Borrowers can use this to pay for different costs, assets, and projects. And then second, building credit. People and businesses can build a good credit path and rise their credit scores by using bank loans. Responsibility and a good credit score makes it easier to get credit in the future and may even lower the cost of getting money. And then third, flexibility. You can choose with a good choice the loan amount, the length of the time you pay it back, and the interest rate. So there are many types of credit products that borrowers can choose from based on their wants and finances. I think it is enough. Thank you.